We want to quickly look at the users of accounting information. That is what we generally know as stakeholders. Right here we're having about 11 users, but I'll be, when I pick one, I will talk intensively on each of them, and after which we are going to classify these users where they belong to, because they can further be classified into internal or external users. We'll be doing that, but let's go look at each of these. The first user here is management. Management is part for one of the major internal users of financial information. It includes owners, it includes partners, it includes board of directors, it includes managers at various levels, it includes departmental heads, and it includes supervisors. We call them internal users. They have interests. They want to appraise the performance of the company. They have questions like, can we afford to hire new employees or increase wage? They have questions like, is there sufficient cash to honor obligations? They ask questions like, how much does it cost to produce 1 unit of a product or a service they are engaged in? Then they also ask a question of, how can we invest in new equipment? So these are the questions internal users want to attend to, and these internal users ranging from management at all various levels, owners of the business, partners, board of directors, managers of various departmental heads, supervisors. They constitute internal users. Competitors are external users. They are external users. Government is also an external user. Government is interested in the financial statement of a company or of a reporting entity from its agencies, like the internal revenue, like the state's inland revenue services, like the government economic agencies or planners. They are interested in the financial statement of what, of a company in question. The regulatory authorities are also involved. They are also interested in the statement of a company. For instance, the stock exchange market, the Security and Exchange Commission (SEC) are also interested. They have interest in the statement of a company. I can include them as one of the users. I call them security agencies, which are the stock exchange. The stock exchange is also having interest. Then we'll talk about SEC, Security and Exchange Commission. Okay. Also, we have economic planners. Economic planners like the analysts. The analysts, they find their way. There is financial advisors, the stockbrokers. In fact, this list is so broad. We have stockbrokers. Stockbrokers are also part of it. We have the financial press or financial analysts. They are also what? They are also part of the users of accounting information. Okay. The tax authorities are not left out, as I said, because they are under the what? Under the government. So tax authority are also users. The public are classified under groups. So we have public, we have customers. We have labor union. That is under the public that are interested. Labor union are also interested in financial statement of a company. And employees also find their way here. They are also interested. They want to know if they are properly remunerated, considering the financial returns of the company in question. Then the following people have direct interest with the financial statement. There is the investors, the present investors, the potential investors. Creditors also have the creditors also have a direct financial interest, or in the accounting information presented by a company. So these are the users of financial statement. I want to classify them. So look at these classes. We have those one we call the internal users. Who are internal users? Internal users are people who participate in preparation of the financial statement. They participate in the preparation of the financial statement. They include what? They include the management. And under the management, the categories are, we have categories here are, we will talk about the owners. I will talk about the partners. The partners are also part. Talk about the partners. We'll talk about the board of directors. The board of directors are also part of it. We talk about the managers. We talk about departments. Department heads. They are part of the management. We'll talk about supervisors. Supervisors are also interested. Supervisors are also what? Interested. So we'll talk about supervisors. Okay. Then we'll also talk about supervisors also form part and parcel of the management that are interested in the financial information of the reporting entity. So management are part of these are what constitute management, which are the internal users. Now for the external users, they are people who do not participate in the preparation of the financial statement, but they have an interest in the financial statement. They have a stake. They have an interest, and we'll be looking at this stake based on what? Direct interest, direct financial interest. Those who have direct financial interest. Those who have direct financial interest. We are talking about present investors. Present investors have direct interest in the financial statement of the company. Also, we have potential investors. Potential investors have direct interest in the financial statement of the company. Creditors who lend money to the company also have direct financial interest. Then we talk about the banks and financial institutions. They also have direct interest because they have direct financial interest in the information provided by the financial statement of a company. Then we have other lending agencies also have a direct interest. So these are external users classified based on what? Based on direct influence. Then external users based on government. Government is an external user. Okay, and this year we'll talk about the inland revenue. The inland revenue services. In Nigeria here, we will call it what? The FIRS, Federal Inland Revenue Service. Okay, and other tax authority. They talk about government planners. Talk about government planners. Okay, the economic planners. They also have interest on the financial statement of a reporting entity. Okay, then regulatory bodies are classified under external users, and under the regulators or regulatory agency, regulatory agency. Under the regulatory agency, we'll be talking about the first. There is a stock market, as I mentioned earlier on. The stock exchange has interest. We'll talk about the security and the exchange commission. The Security and Exchange Commission. I talked about that earlier on. That is the SEC. Okay. Then we stay under external users. We can see the economic planners. Economic planners are external users, and these economic planners range from financial advisors. Financial advisors find their way here. Now stock brokers, because they are also advisors to their clients, stock brokers, and also the financial press. The financial press form the economic planners. Then we have other groups that are other groups that are under external users. Includes employees, include labor union. They are unions. Then the customers. You will not ask me what's the interest of the customers. What interest does the customer have on the financial information of a company? General public. The customers want to know the long-lasting supply of the services or the company, or the services or the goods which the company is providing. Now, internal users and external users, as I said, they have questions they want to answer. There's a stake they have in a company, and the questions they want to answer. To the internal users, they want to provide solutions to questions like, can we afford to hire new employees or increase the wage? Okay, and they also want to know if for the financials, is there sufficient cash to honor present and future obligations? Then they also want to know how much does it cost to produce 1 unit of their products. As internal users, they also want to know, can we invest in new equipment? Is there business opportunity that is open? Can they invest considering the financial position of the company? And as external users also have questions they want to provide answers to. And these questions are: is the business making profits? Can the company afford to pay dividend? That is what stakeholders, shareholders want. And if they can afford to pay dividend, how much is the extent? Then the question is, the external users also ask questions like, will the business be able to meet its obligation when fall due? That is the lenders, the money lenders, the creditors. They want to find answer to this question. Will the business be able to meet its obligation when fall due? Another question that what external users would like to find answer to is, how is the business performing in comparison to its competitors? Then there are questions like, is this merger, acquisition, or takeover of benefits to us? That is, the external users want to know if business merging or business acquisition is of benefit to their interests. They also want to answer questions like, is the company following accepted standards when preparing its financial statement? Because the standards are meant to provide and protect and ensure the code of ethics and code of conduct that the interest of the various parties are being ensured and be satisfied when preparing the financial statements. So these are the questions which external users would like to provide answers to, and these questions can only be found due to their interest on the financial statements. Right now, let's quickly look at what we call accounting equation. And the total of financial accounting is based on the accounting equation. The principle of double entry developed from the what? From the axiom of the what? Of the accounting equation as well. So the fundamental equation is what? Is given as assets equals to capital plus liability. So the accounting equation emphasizes the equality between the assets and liabilities in of an organization. And when we talk about liability, all of these are referred to as liabilities in the actual sense, because capital in its actual sense is also a liability. Okay, now, so A equals to capital plus liability. So if I'm looking for capital, it will become A minus L, that is subject of formula. And if we're looking for L, it will become from this, it will become A minus what? Minus C. So this is the accounting equation. But before we start putting it in practice, it is necessary to look at what assets are. What is an asset? What is a liability? Okay, so now these are the basic concepts we have to know. Business entity concept, we have what we call one of the accounting concept and convention. We have what we call business entity concept. We will be looking at that later. Regardless of how a business is what, regardless of how a business is being owned, whether it is a sole trader or partnership, the business entity concept is recognizing that every business has a separate entity. The business is being separated from the real owner. So regardless of how a business is legally set up, in accounting, a business is always treated as separately from what? From its owner. So we must take that concept into consideration in all accounting, irrespective of the forms of business ownership. Now, in accounting, capital is an investment. Capital is an investment of money that is formed with the intention of earning what? Earning a return. So a business proprietor invests capital with the intention of earning what? Earning profit. So as long as the money is invested, accountants we treat the capital as money owed to the what? Owed to the proprietor by the what? By the business. So you can see in the actual sense, capital that is being introduced by the owner of the business is a liability. Is a liability, and that is how it's being treated in accounting, holding on to the concept of a legal entity. Holding up to the concept of legal entity. So that is how we treat capital. Now let's quickly look at those components of accounting equation: asset, liabilities. Asset, liabilities, and we'll look at their recognition according to accounting standard IAS 1. This definition is based on accounting standard IAS 1. So let's look at what assets are. Assets are resources. Assets, they are resources controlled by the entity. Now look at the control word. They must be controlled by the entity as a result of past events, and from which future economic, these are the basic elements when you are defining an asset. From which future economic benefits are expected to flow to the entity. This is what makes an asset to be an asset. It must be under the exclusive control of what? Of an entity before it's classified as what? As asset. And it's as a result of past events, and not only that, future economic benefit must flow. Or is expected to what? To flow to the entity from the use of that word, of the use of that asset. Okay, so what is liability? Liability represents obligation of an entity. It must be obligation, either a contractual obligation. It must be obligation of an entity. It's also arising from what? From past events. It's arising from what? Past events, the settlement of which is expected to result to an outflow. In order to settle it, there must be an outflow. An outflow from the what? From the entity resources embodying economic what? Benefits. So for a liability to exist, it must be an obligation, and it must be from the past event, and in settlement of it, there is an outflow of economic resources of the entity in question. So this is the standard definition of asset and the standard definition of a liability. Once again, assets are resources controlled by the entity as a result of past events and from which future economic benefit are expected to flow to the entity. Whereas liabilities represent or present obligations of is a present obligation of an entity arising from past events and settlement of which is expected to result in an outflow from the entity of what resources embodying the economic benefits. So that is what liabilities are. So let's look at how we recognize liability. That is and recognition of what of this asset or liability. We have to look at it at initial recognition. When is asset or liabilities initially recognized as an asset, or when an item is initially recognized as an item? So we'll look at it as initial recognition. Recognition is the process of incorporating in the statement of financial position or statement of comprehensive income an item that meets the definition of an element and satisfies the criteria for what? For recognition. So we're talking about assets, liabilities, equity, income, and what? And expenses. When should we recognize them? Do they meet the required definition of what an asset should be, or what a liability should be, equity should be, income should be, and what expense should be? So elements should only be recognized in the financial statement if number one, it is probable that any future economic benefit associated with it, benefit associated with the item will flow to an organization or from an entity. It is an asset, it is an income. The future benefits associated with the item will flow in to the organization. If it is an expenses, if it is a liability, it will flow out from the what? From the entity. That's the first condition. 2, the item has a cost or a value that can be measured with what? With reliability. It must be measured with what? Reliability. That's the second condition. Then after which, subsequent measurement of what? Of an item, an element of asset, liabilities, income or expenses. What will be the subsequent measurement? Measurement is a process of determining the monetary amount at which the element of the financial statement are to be recognized and carried in the statement of financial position and statement of comprehensive income. The following bases are used to different degrees and in varying combination to measure the element of what? Of a financial statement. Number 1, the subsequent measurement will be what? Historical costs. Of course, you know it is peculiar with financial accounting. Historical costs are assets are recorded at the amount paid or fair value of consideration given to acquire them at the time of what? At the time of their acquisition. Then on the other hand, liabilities are recorded at the amount of proceeds received in exchange for the what? For such obligation. That is when we'll be using historical costs. We can also use we can use the current cost. So a subsequent measurement of this asset, liability, expenses, and income. Subsequent current cost. Assets are carried at the amount of cash and cash equivalent that would have to be to be paid if the same or equivalent asset we are acquired currently. Whereas liabilities are carried at the undiscounted amount of cash or cash equivalent that will be required to settle the obligation currently or presently. Then the last method of a subsequent measurement of those elements of financial statement, which could be asset, liabilities, income, or expenses. Now, realizable what? Realizable value. Realizable value or settlement value. Now, assets are carried at the what? At the amount of cash and cash equivalent that would be obtained by selling the asset in an orderly what? Disposal. Orderly disposal is the key word. Orderly, in a normal situation, in a normal market condition, at arm's length, at fair value. So liabilities are what? Are carried at the settlement values, that is the undiscounted amount of cash or cash equivalent expected to be paid to satisfy the liabilities in the normal what? In the normal cost of what? Of the business. So these are the subsequent measurement of asset and liabilities. We can measure them historically, current cost, or we can use what? Realizable value or settlement value. So having discussed asset and liabilities, it is necessary we look at the classification of the asset, classification of liability, before we now look at a critical example on accounting equation, and we'll forge ahead. So let we look at classification of asset and liabilities. For the asset side, assets are classified majorly into two. Assets are classified into two. Assets, they are majorly classified into two. We have what we call the current asset, and we have what we call the non-current asset. In your old standard of statement of accounting standard, we call it fixed asset, but please, I don't the IFRS say we should this should be called, this is known as what? This is known as current, is known as non-current what? Assets. Well, let's discuss the current asset. What constitutes a current asset? Why do we call it a current asset? These are the features that what will make an asset to be classified as what? As a current asset. One, an asset will be a current asset when the asset is expected to be realized or intended for sales or consumption in the entity's normal what? Operating cycle. For instance, inventories, because stocks is outdated. Inventories are what? Are tagged current asset because they are consumable, or your inventory of raw material, your inventory of finished goods, they are consumable. Within an entity on the normal operating cycle. Asset held primarily for trading. Assets held primarily for trading are classified as current assets. Yes, we know that what? We know that the lifespan of motor vehicle are what? Span over a year. That doesn't mean that what? A business that is trading on what? On cars and motors and lorries, that is their primary course of business. That's what they are trading. That's what they are selling. That's what they are buying. To them, those cars they are selling, they are buying, to them is not an asset, it is goods. They are held primarily for what? For trading. Asset expected to be realized within 12 months after the reporting date. Within 12 months after the reporting date. Asset that lasts for a span of 1 year of realizing 1 year of what? Recovering or realizing their value. They are tagged as what? As current asset. For instance, your prepayment. The prepayment is part of it. The receivables, which we normally call debtors, is part of it. So they are what? They are recoverable. They are realizable within 12 months after the reporting what? After the reporting date. Then cash or cash equivalent. Cash or cash equivalent. Unless the assets are what? Are restricted in the use of for at least 12 months after the what? The reporting period, or are to be what? To be used to settle a what? A liability. So that is what these are what constitutes liability, current assets. Let's look at the next, which is current what? Which is liability. Liabilities are classified into what? But before we look at liability, the non-current assets are assets that are what? They are tangible assets that are bought for the use of the business. For the use of the business. And they have a long span more than what? More than a year. The long span is more than what? Lifespan is more than what? More than a year. That is what we call current asset. They are not intended for sales in the ordinary course of the business. That's what we call the non-current or non-current assets. Now the liabilities are divided into two as well. Current liabilities and non-current liabilities. What shall constitute a current liability? A current liability. Current liabilities. 1. Liabilities expected to be settled in the entity's normal operating cycle. They are expected to be settled in the normal operating cycle. The liability are held primarily for what? They are held primarily for trading. We refer them as what? As a current liabilities. The liabilities due to be settled within 12 months after the reporting date. Accruals, for instance, accrued rents. They are what? They are current liabilities. Your creditors, which you call the payables. They are what? They are current liabilities. Liabilities for which the entity does not have an unconditional right. Unconditional right to defer settlement for at least 12 months after the reporting period also constitute a current liability. So the non-current asset and liabilities are expected to be settled more than 12 months after the reporting date. So this is the classification of the asset and liabilities. Okay, so the next you can move now. You can now comfortably look at an illustration regarding to assets, regarding to accounting equation. We state that at any point in time, asset of a business must be equal to summation of capital and liability. Okay, so we have this question on the screen. We have to find this missing figures.